Doesn't take much to guess that 2020 will not be a good year for South Africa's economy. The SA Reserve Bank cut interest rates yesterday by 100 basis points to 4.2%. This is to ease liquidity strains in the market caused by the COVID-19 outbreak. SARB also predicts GDP to contract by 6.1% this year. Meanwhile, the rand continues to take a beating, hovering around 18 rand to the dollar. PwC's chief economist, Lullu Krugel, speaks to us now. Very good morning to you, Lullu. Let's start off with a little bit of good news there. Means that we possibly could have more money in our pocket.
Jane, yes, we've seen a surprise, 2 interest rate cuts by the SARB. I think economists were widely expecting the SARB to step in by cutting interest rates, but this latest one came earlier than we expected. So in total, 200 basis points or 2 percentage points being cut. So for those of us with debt and worries about, which is the majority of South Africans, of course, at this point in time, worries about our financial future, it is a bit of good news at this point in time in terms of the fact that we will be paying a little bit less for our home loans and bonds and other types of debt that we might have.
But you shouldn't lower payments if you don't have to, should you?
Absolutely not. If you can in any way avoid, lowering your payments, that is your first choice. Of course, I mean, if one is in a position where you really don't have any other options, it's a different situation. If you've lost your job, etc. You know, some of the banks have also given options to people with small businesses, etc., that might not be earning income over this period of time to actually defer some of the payments to later. But unfortunately, that will mean that your overall interest payments in the long run becomes more, and you might just create a problem down the road. So if you don't have to do this, rather not.
And do you agree with the growth predictions that GDP will contract by 6.1% this year?
Jan, unfortunately, over the last week or so, and that's literally the time frames that we as economists are talking about now, is days and weeks. It's not months and quarters and years anymore as we are used to. We've seen some predictions coming out about what will happen with the South African economy that's been looking significantly worse than even 2 or 3 weeks ago. At that point in time, a lot of economists were talking about a contraction of 1 or 2 or 3% in the worst case. And now with the SARB, with an over 6% or expecting over 6% contraction, we've seen numbers in the region of 6 and 7% in the market. So unfortunately, that's the ranges that we are looking at. And as we know, that is record contractions in the economy. It's some of the worst numbers that we've seen since the 1970s.
And with this news affecting the rand, where does that leave us ultimately?
So unfortunately, as you rightfully said, the rand is unfortunately taken a beating over the last couple of weeks. It's been mainly driven by what has happened in international markets and COVID-19. Of course, yesterday's surprise decision by the SARB to cut interest rates has resulted in the rand weakening, because it basically means that our interest rate differential, or what you can get if you invest in South Africa, is now less versus other countries, and therefore it makes us less attractive as an investment destination. But I suspect that yesterday's move in the interest rate cut had a short-term impact on the rand, and the more important factor, unfortunately, at the moment is what's happening in the international markets. So it might have an impact on imported inflation down the line, but especially if you look at the fact that we import most of our fuel. But with oil prices being so low at the moment, and actually our demand and use of petrol so low, it's at this point in time not hurting the average South African so much, and it could actually be good news for our exports and our export market. We just hope that it's not a trend that will continue indefinitely.
Lullu Krugel, thank you very much. Let's take a look at the financial markets now.